Imagine a world without money. A world where you'd trade a chicken for a bag of rice, or work an entire day for a piece of cloth. No credit cards, no bank accounts, no digital wallets. Just raw, direct exchange. Now, fast forward to today's digital age, where millions of dollars move across the globe with a single click. How did we get here? How did humanity go from bartering livestock to mining cryptocurrencies like Bitcoin? The story of money is not just about coins and bills, it's about trust, innovation, and the evolution of human society. Money is one of the most powerful inventions in human history. It has shaped empires, fueled revolutions, and transformed the way we live, work, and interact. But money didn't start as the complex system we know today. It began with something much simpler: barter. Over thousands of years, it evolved through coins, paper, gold, and now digital bytes. Each stage of its evolution reflects the needs, challenges, and aspirations of the time. In this video, we'll take you on a journey through the complete history of money. We'll explore how ancient civilizations moved from barter to the first metal coins, how paper money revolutionized trade, and how the gold standard shaped the modern economy. We'll also dive into the digital revolution, from the rise of electronic payments to the groundbreaking creation of Bitcoin and blockchain technology. By the end of this video, you'll understand not just where money came from, but where it might be headed in the future. So whether you're curious about the origins of your wallet's contents or fascinated by the future of finance, this is the story you don't want to miss. Let's dive into the incredible history of money, from barter to Bitcoin. Before currencies and banks, people exchanged goods and services directly. No money involved. But, as you'll see, this simple system had its limitations. Barter is defined as the direct exchange of goods and services without using money. It's the first and most primitive form of trade. Imagine this: you have a surplus of something like grain, but you need something you don't have, like livestock. In a barter system, instead of buying the livestock with money, you simply trade a portion of your grain for the animals you need. Similarly, if someone has tools and needs fabric, they could swap their tools for fabric without involving any currency. Barter systems are as old as civilization itself and were essential in early societies. This system worked in small communities or in cultures with limited access to money. However, barter required both parties to have something the other person wanted, a concept known as the double coincidence of wants. If you wanted to trade grain for tools, but the other person didn't need grain, the trade wouldn't happen. This is one of the fundamental challenges of barter systems. In these early exchanges, goods were often valued based on their utility. The trade wasn't just about possession. It was about the practical use of the items involved. For example, a basket of grain could be traded for livestock that could help with farming, thus benefiting both parties in tangible ways. While the barter system was effective in small, close-knit communities, it had several significant limitations that became more apparent as societies and economies grew. One major limitation was lack of divisibility. Take a cow, for example. If you want to trade a cow for goods or services, but the value of the cow doesn't match the value of what you need, it becomes a problem. You can't just easily divide the cow into smaller, usable portions, like you could with money. Dividing goods into smaller, more manageable units was simply not practical. A cow might be worth more than what someone wanted to trade for it, or the goods in question might be worth less than a whole cow. Another major issue was the double coincidence of wants. This concept is at the core of barter's inefficiency. Let's say you have grain, but the person you want to trade with doesn't need grain. Perhaps they need leather. Unless you can find someone else willing to trade leather for grain, your transaction can't happen. This often made exchanges complex and time-consuming. In a community where needs and wants varied greatly, finding a suitable trade partner was a significant challenge. Additionally, as populations grew, it became harder to maintain the intricate web of trades necessary to keep an economy functioning smoothly. The complexity of matching goods with people who wanted them limited the growth of trade networks and prevented economies from developing further. Despite its limitations, the barter system was an essential part of many early societies, from the Mesopotamians in ancient Sumer to the Egyptians along the Nile. In Mesopotamia, one of the earliest cradles of civilization, barter was the foundation of trade. Grain was commonly used in exchange, particularly in societies like Sumer, where agriculture played a central role. Farmers often exchanged grain for other agricultural products like livestock or tools. This allowed people to meet their basic needs while facilitating a simple economy. At the time, writing was emerging, and cuneiform tablets were sometimes used to record trade transactions, further laying the groundwork for more formal systems of trade and record-keeping. In ancient Egypt, barter was also central to the economy. Farmers would trade grain with craftsmen in exchange for goods like tools or cloth. However, trade wasn't just limited to local exchanges. As Egypt's trade networks expanded, people began exchanging goods like luxury items, spices, and raw materials with neighboring regions. Egypt's barter system was intertwined with early forms of written contracts, marking the transition from informal to more structured trade. Even among Native American tribes, barter played a key role. For example, fur traders would exchange fur for corn, which was a staple food for many tribes. This kind of trade helped to connect distant tribes and communities across vast territories, creating early networks of trade that would later be formalized into more complex economic systems. The barter system was the bedrock of early trade and laid the foundation for the complex economies we have today. While it had limitations, such as the inability to divide goods and the challenge of finding a matching exchange, barter helped societies grow and laid the groundwork for more advanced economic systems. Over time, these limitations led to the development of money as a universal medium of exchange, solving many of the problems that came with direct trade. A critical step in the evolution of money is the emergence of commodity money. Before coins and paper currency, humans used objects with intrinsic value for trade. So, what exactly is commodity money? Simply put, it's money that derives its value from the intrinsic worth of the item itself. Unlike modern fiat currencies, which hold value by government decree, commodity money was valuable because the goods were useful or desirable on their own. Think of salt, cattle, or cacao beans. These were more than just trade items, they were practical, essential, and widely valued. Salt could preserve food, cattle provided labor and meat, and cacao beans were even used to make drinks in Mesoamerica. Their usefulness made them universally accepted in trade. The beauty of commodity money was its portability and divisibility. Unlike bartering, where it was difficult to split a cow into smaller units of value, commodity money allowed people to trade in standardized, recognizable units, like bags of grain or measured weights of silver. The key feature of commodity money was that it provided a universal standard that could be used to facilitate trade between people who otherwise may have struggled to find a match for their needs. It allowed people to store value in a way that didn't rely on trust alone, but rather on the tangible value of the goods themselves. Over time, various commodities became widely accepted as forms of money, each serving as a stepping stone toward the more formalized systems we use today. Let's look at a few of the most famous examples. The first recorded use of commodity money dates back to Mesopotamia around 3000 BCE. The Sumerians, famous for their early cities and irrigation systems, used barley as their primary form of money. Barley was both practical and valuable, serving as food and currency. To standardize trade, the Sumerians measured barley by weight, using units like the shekel. Workers were often paid in barley, while larger transactions, such as land purchases, were settled with silver by weight. This marked one of the first examples of standardized currency exchange, laying the foundation for more complex financial systems. In ancient Egypt, around 2500 BCE, commodity money took on a larger, more mobile form: livestock. Cattle, particularly oxen, were highly valued. In fact, the term pecuniary, which we use today to describe financial matters, comes from the Latin word pecus, meaning cattle. The Egyptians recorded transactions in terms of cattle units. For instance, a field might be valued at 3 oxen, while smaller purchases were traded for measures of grain. To store wealth, Egyptians also relied on grain warehouses, where large reserves were kept. Grain receipts acted as early forms of banknotes, representing stored value. Another fascinating example comes from the use of cowrie shells, which served as a currency in various parts of Africa, Asia, and the Indian Ocean islands for centuries. These shells were valued not just for their rarity, but for their beauty and durability. Cowries became a form of money in several cultures, from ancient China to the coastal regions of East Africa. For example, in ancient China, around 1200 BCE, during the Shang dynasty, these shells became a widely accepted form of currency. Their use as currency persisted until the late 19th century in some parts of the world, and they are considered one of the longest-lasting forms of commodity money. The value of cowrie shells was recognized across cultures, making them an effective means of trade across vast regions. In ancient Greece, around 1100 BCE, commodity money evolved into a more practical form: bronze spits. Known as oboloi, these metal rods were used for both cooking and currency. 6 spits were equivalent to 1 drachma, creating an early standardized unit of exchange. However, carrying bundles of metal rods was cumbersome. This inefficiency eventually led the Greeks to develop metal coinage, which was smaller, more portable, and easier to standardize. One of the most famous examples of commodity money was salt. In ancient Rome, salt was so valuable that it was used as a form of payment for soldiers. This is where the word salary comes from, the Latin word salarium, which refers to the money allotted to soldiers for the purchase of salt. Salt was essential for preserving food, especially in a time when refrigeration didn't exist, making it incredibly valuable in everyday life. The idea that soldiers were paid in salt not only underscores the importance of this commodity, but also shows how essential commodity money could be in supporting empires and armies. The introduction of commodity money brought significant advantages over the barter system. One of the biggest advantages of commodity money was that it provided a standardized value. Unlike bartering, where the value of goods was subjective and often inconsistent, commodities like salt, cowrie shells, and precious metals had generally accepted values. For example, a barter exchange might see a farmer trade grain for livestock, but the value of the grain might fluctuate based on factors like the harvest season. However, salt or gold had a known and accepted value, making trade easier and more predictable. This system created more stability in the economy, as goods had clearly defined worth and were easier to assess when conducting transactions. Another key advantage of commodity money was its portability. In the barter system, goods like cattle or grain could be difficult to transport, especially over long distances. However, commodities like silver coins, gold ingots, or even cowrie shells were small, lightweight, and easy to carry. This portability made trading across larger territories or even across borders more feasible. For example, a merchant traveling to another city could carry silver coins, rather than worrying about finding someone who wanted to exchange the same goods. Additionally, commodity money was far more practical than bartering because it allowed people to engage in trade with far fewer obstacles. No longer did two parties need to find a double coincidence of wants. Commodity money solved that problem by offering something universally accepted and easy to carry. This advancement opened up new opportunities for economies to grow, trade to expand, and people to store wealth more securely. As societies grew and trade expanded, precious metals like gold and silver became the most dominant forms of commodity money. Their widespread use was partly due to their durability. They didn't decay or corrode easily, and their divisibility. They could be melted down and shaped into smaller units for easier trade. Gold, in particular, was often associated with wealth and power, and its use as money became more common in ancient civilizations like the Greeks and Romans. Over time, silver and gold replaced many other forms of commodity money due to their ability to store value over long periods, their portability, and the fact that they were universally accepted. The emergence of commodity money marked a significant turning point in the history of trade and economics. Salt, cowrie shells, gold, and silver became the building blocks for the money systems we know today. They provided standardized value, portability, and a more reliable way to engage in trade, moving beyond the limitations of the barter system. As trade expanded and societies grew more complex, commodity money set the stage for the development of more formal currency systems like coins. Commodity money had practical value beyond being a medium of exchange. Coins, on the other hand, introduced standardized government-backed currency. While they were often made of valuable metals like gold or silver, their value was stamped by a governing authority. The coin's value no longer depended solely on the metal content. It was partially based on the trust in the issuing power. Coins were also more practical. Unlike bulky or perishable commodity money, coins were uniform in size, easier to transport, and more durable. This standardization made large-scale trade simpler and more efficient. The transition from commodity money to coins marked the beginning of formalized currency systems, laying the groundwork for the global financial systems we recognize today. The story of coins begins in the ancient region of Lydia, located in modern-day Turkey, around 600 BCE. This is where we find the first standardized coins made from electrum, a naturally occurring gold-silver alloy. The Lydians were the pioneers of coinage, creating a tangible, standardized form of currency that could be used for everyday trade. Lydia's electrum coins were stamped with symbols, often the image of a lion, representing the power of the Lydian king. These symbols helped establish the coin's legitimacy and were a way of enforcing trust in the new form of money. The use of coins quickly spread beyond Lydia as neighboring regions recognized the advantages of a standardized, durable medium of exchange. Around the same time, in ancient Greece, coins began to take hold. Greek city-states adopted the Lydian coinage system, refining the design and minting techniques. Greek coins became famous for their artistic quality, often featuring detailed images of gods, leaders, and mythological creatures. The Athenian owl coin, which depicted the goddess Athena, is one of the most iconic examples of Greek coinage. The expansion of coin use helped facilitate Greek trade, making it easier to buy and sell goods across their vast empire. In ancient Rome, coins became integral to the Roman economy. The Romans took coinage to a new level by introducing denarii, silver coins that became the backbone of Roman commerce. The use of coins also helped finance the Roman army, and it played a key role in the Roman Empire's vast expansion. Over time, Roman coins came to symbolize the empire's strength and prosperity, often carrying the image of the emperor, which reinforced the legitimacy of the Roman state. Coins offered several key advantages over commodity money. which helped explain their rapid adoption across ancient civilizations. The primary benefit of coins was that they provided a uniform value. Unlike barter, where the value of goods could vary from one person to another, coins had an agreed-upon value that was standardized. A coin minted from gold or silver would have the same value no matter where it was used. For example, a coin worth 1 drachma in Athens would be worth the same in any part of the Greek world, allowing for more consistent trade. This uniformity helped establish trust in the currency, as both buyers and sellers knew exactly what they were dealing with. Coins also solved one of the major problems of commodity money: portability. Carrying grain, livestock, or even precious metals like salt was cumbersome and impractical, especially for long-distance trade. Coins, on the other hand, were small, lightweight, and easy to carry. A merchant could transport large sums of money in their purse, making trade much easier. Coins were also durable, unlike many commodities, which could spoil or lose value over time. Gold and silver coins in particular had intrinsic value, which made them reliable for both trade and wealth storage. Another advantage of coins was how easily they could be stored. Unlike bulky goods that required space and effort to safeguard, coins could be stacked, stored in containers, or carried in bags. This made it easier for individuals and merchants to store wealth in a compact form. Coins were also easily exchangeable for other goods and services. They helped simplify trade, as individuals didn't need to find someone who wanted to trade directly with them, like in the barter system. The standardized value and portability of coins made it much more efficient to exchange goods and services. Once coins were established in Lydia and spread across the Greek and Roman worlds, their usage expanded even further, and different civilizations began adopting and adapting the concept. The Persian Empire, which stretched from Egypt to India, was one of the first to embrace the use of coins for taxation and trade. The Persian king, Darius I, recognized the utility of coins for unifying his vast empire. The Persian darak, a gold coin introduced during Darius's reign, became widely used across the empire. The coin was standardized, making it easier for traders, merchants, and government officials to conduct transactions. It was used not only for trade, but also to pay soldiers, pay taxes, and store wealth. The spread of coins in Persia helped promote economic stability and facilitate trade between regions. On the other side of the world, China developed its own forms of coinage, which were quite different in design from the Greek and Roman coins. In ancient China, spade coins and knife coins were created as early as the 5th century BCE. These coins were shaped like small spades or knives, and they served as the earliest forms of currency in China. Unlike the round coins we are familiar with today, these unique shapes were a reflection of Chinese metalworking and were designed to be easily recognizable and practical. Spade coins were primarily used in the Zhou dynasty, while knife coins became more prevalent during the Qin dynasty. The Qin dynasty in particular standardized the use of currency and created coins that were used across the empire. Over time, China refined its coinage system, eventually producing round coins with a hole in the center, which could be strung together to form a chain of coins, an efficient way of carrying and storing money. Coins spread across different regions and empires, becoming integral to trade, taxation, and the organization of economies. The Roman Empire, the Persian Empire, and ancient China all contributed to the globalization of coins as a medium of exchange. While the specific designs and materials varied, coins shared a common purpose: to provide a standardized, portable, and reliable form of currency that could be used to facilitate trade, consolidate wealth, and promote economic stability. The invention of coins revolutionized trade and finance, making it easier for civilizations to conduct business and store wealth. Coins brought uniform value, portability, and efficiency to ancient economies, setting the foundation for modern currency systems. From the first electrum coins in Lydia to the widespread use of coinage in the Roman and Persian empires, coins became a vital tool in shaping the economic landscape of the ancient world. As coins became the dominant form of currency in the ancient world, they didn't just revolutionize trade, they also laid the foundation for the first banking systems. The ability to store, lend, and exchange coins gave rise to early financial institutions where merchants, traders, and even governments could deposit their wealth, borrow funds, and conduct large-scale transactions. What began as simple coin exchanges soon evolved into organized banking practices, with moneylenders offering loans, charging interest, and even facilitating currency exchange. This shift marked the birth of banking as a vital tool in shaping the economic landscape of the modern world, a system that would continue to grow in complexity and influence over the centuries. The origins of banking can be traced all the way back to ancient Mesopotamia, around 2000 BCE, in the region known as the Cradle of Civilization. In these early societies, temples played a central role in daily life, serving not just as religious hubs, but also as places where people could store and lend resources. As we already discovered, one of the most important assets in Mesopotamia was grain, a staple of the diet and a form of wealth. These temples acted as early banks, storing grain for the community and lending it out at interest. In return, borrowers would repay the grain with additional interest, essentially making it the first known loan and interest system. In ancient Rome and Greece, the practice of lending money and charging interest became more formalized. Early moneylenders in Rome, known as argentarii, conducted business from the forum or market, offering loans to individuals, merchants, and even the state. They would charge interest on these loans and keep records of transactions, something that was crucial for the development of a more organized financial system. These early loan systems were often secured by collateral, such as property, land, or crops, and interest rates were agreed upon in advance. During this period, the concept of banking was still very primitive. It was more focused on lending and borrowing goods, like grain or coins, rather than managing and exchanging currencies across different regions. However, these rudimentary systems were vital in establishing the foundation for future banking institutions. The next major leap in the evolution of banking occurred during the Middle Ages, a time when Europe was in the midst of a commercial revolution. With the rise of trade and the increasing need for more organized systems of finance, banking began to take on a more structured and institutionalized form. One of the most important developments during this period came in Italy, specifically in the city-states of Venice, Florence, and Genoa. These cities became bustling centers of trade, and the demand for banking services increased. The Medici family of Florence became one of the most influential and famous banking families of the 15th century. They established the Medici Bank, which was one of the largest and most prosperous banks in Europe at the time. The Medici Bank pioneered many modern banking practices, including the use of letters of credit, which allowed merchants to conduct long-distance trade without having to carry physical money. The bank also introduced the concept of double-entry bookkeeping, a revolutionary accounting method that made it easier to track income, expenses, and profits. This system would go on to become the foundation of modern accounting and financial management. The Medicis also helped finance the arts, becoming patrons of renowned artists like Leonardo da Vinci, Michelangelo, and Sandro Botticelli. Their banking practices were key to the Renaissance in Italy, fueling economic and cultural growth. The Medici family's rise to power in banking was not just about financial success. It also had a profound impact on the political and cultural landscape of Europe. Another significant group involved in early banking was the Knights Templar, a religious military order that became active during the Crusades. The Templars, originally founded to protect Christian pilgrims traveling to the Holy Land, became financial intermediaries for these pilgrims. They set up an early form of banking system where pilgrims could deposit money in their home country and withdraw it in the Holy Land, a precursor to modern-day bank accounts. The Templars also acted as money changers, exchanging currencies and facilitating trade across Europe and the Middle East. Their banking system was one of the first to allow for safe, secure international transactions. The impact of banking on trade and the economy was profound. Banking didn't just allow people to store and lend money. It transformed the way people conducted business and helped fuel the expansion of trade across vast distances. One of the most important contributions of banking was the development of credit systems. As trade grew, merchants and governments needed access to funds that exceeded the available cash in circulation. This led to the creation of credit, which allowed individuals and businesses to borrow money and repay it over time. By offering credit, banks helped stimulate the economy, enabling people to invest in larger ventures, expand businesses, and trade goods more freely. Credit also allowed for the financing of wars, with kings and rulers borrowing money from banks to fund military campaigns, further expanding the role of banking in politics. The currency exchange market also grew alongside banking. As European powers began to explore and colonize other parts of the world, the need for currency exchange between different regions became increasingly important. Banks helped facilitate this exchange, allowing merchants to conduct business across borders without worrying about fluctuating exchange rates or the need to carry vast amounts of currency. This created a more interconnected global economy where international trade could flourish. The rise of banking also had a profound impact on the development of financial markets and institutions. The ability to lend, borrow, and exchange money across regions laid the foundation for the creation of more complex financial systems, such as stock markets, bonds, and insurance. It also allowed governments to issue sovereign debt, which has become a crucial tool for financing national budgets and economic development. The birth of banking and early financial systems was a pivotal moment in the history of money. From the first rudimentary loan systems in Mesopotamia to the rise of the Medici family and the Knights Templar as financial intermediaries, banking helped shape the economic landscape of the ancient and medieval worlds. The credit systems and currency exchanges introduced during this time laid the foundation for the global financial systems we rely on today. But before we dive into this topic, let's talk about another big step in a history of money: paper money and the gold standard. The story of paper money dates back to ancient China, during the Tang Dynasty in the 7th century, but it was under the Song Dynasty, 11th century, that paper currency became widely circulated. These notes, known as jiaozi, were initially issued by merchants and later standardized by the government to reduce the need for bulky metal coins. By the 13th century, Marco Polo famously described China's use of paper money in his travels, astonishing European merchants who had never seen a financial system without precious metals. However, it wasn't until the 17th century that paper money began spreading in the West, with Sweden and later the Bank of England, 1694, issuing banknotes backed by precious metals. These banknotes were essentially promissory notes promising to pay the bearer a certain amount of gold or silver. This move was crucial because, for the first time, paper money was backed by tangible assets, ensuring trust in the note's value. The most famous of these banks were in Sweden, where the first official banknotes were issued, setting a precedent for the modern banking system. Now let's move on to one of the most pivotal economic systems in history: the gold standard. The gold standard is a system where the value of a country's currency is directly linked to a specific amount of gold. This system wasn't immediately adopted worldwide, but it began to take shape in the 19th century, and its effects can still be felt today. The United States formally adopted the gold standard in 1834 under President Andrew Jackson. It was a crucial move in stabilizing the U.S. economy after the volatility of earlier decades. Similarly, the United Kingdom fully embraced the gold standard in 1821. For both countries, and later many others, it became a system in which governments agreed to buy and sell gold at a fixed price, effectively guaranteeing the value of their currency based on gold reserves. But the gold standard wasn't just a domestic policy, it had international implications. Under the gold standard, countries could exchange their paper money for gold at fixed rates. This created a sort of global monetary system where the amount of gold a country held determined how much money it could issue. The system created a level of stability and trust, as people and governments knew that money had a tangible value. One of the main benefits of the gold standard was that it provided stability. Currencies were pegged to gold, which meant they couldn't be easily manipulated by governments. This gave consumers and investors confidence that the currency would hold its value over time, promoting trade and investment. This was especially important in the 19th and early 20th centuries, when global economies were still developing. Another key advantage was that it limited inflation. Since the amount of money in circulation had to be backed by a corresponding amount of gold, governments couldn't simply print money to cover debts or fund wars without having the gold to back it up. This ensured that economies remained grounded in reality, preventing runaway inflation. However, there were notable drawbacks to the gold standard, especially in times of economic crisis. For example, during times of war or economic depression, governments needed more flexibility to adjust their monetary policies, such as printing more money or lowering interest rates to stimulate the economy. Under the gold standard, such flexibility was limited, as countries couldn't just print more money without gold reserves to back it up. As the world entered the 20th century, the limitations of the gold standard became more apparent. The Great Depression in the 1930s showed just how restrictive the system could be. The Depression, which began in 1929, caused widespread economic devastation. Unemployment skyrocketed, businesses collapsed, and international trade came to a near standstill. The global economy was in disarray, and many nations were facing severe financial crises. During this period, many countries that were still on the gold standard found themselves in a tight spot. The gold standard required governments to keep a fixed amount of gold reserves to back their money. This meant that governments could only print as much money as they had gold to back it, limiting their ability to respond to economic crises. As the Depression worsened, countries found themselves with inadequate gold reserves to support their economies. In response, many nations abandoned the gold standard. Franklin D. Roosevelt, the U.S. president at the time, took the United States off the gold standard in 1933. This allowed the government to print more money, increase the money supply, and attempt to stimulate the economy. While this action helped in the short term, it also set the stage for a broader shift in global monetary systems. After the chaos of the Great Depression and the financial turmoil of World War II, world leaders realized that they needed a new financial system to ensure global economic stability. 44 allied nations gathered in Bretton Woods, New Hampshire, to establish the framework for a new international monetary order. The key outcome of the Bretton Woods Conference was the creation of a system where the US dollar would become the global reserve currency, meaning it would be used for international trade and held as a reserve by foreign governments. This was a monumental shift in the global financial system, as the US dollar was now effectively the world's primary currency. The US dollar was still linked to gold, but not in the traditional sense. Under the Bretton Woods system, the U.S. agreed to convert dollars into gold at a fixed rate of $35 per ounce. This meant that while the U.S. dollar itself was not directly backed by gold for domestic transactions, other countries could still exchange their dollars for gold from the U.S. government. This gave the dollar a kind of pseudo-gold backing, while allowing the U.S. more flexibility than a full gold standard would have. The Bretton Woods Agreement also led to the creation of key international institutions such as the International Monetary Fund, IMF, and the World Bank, which were designed to help stabilize the global economy and provide assistance to countries in need. The dollar's new status as the reserve currency facilitated international trade and investment, and it allowed the United States to exert tremendous influence over the global financial system. However, the Bretton Woods system was not without its challenges. As the U.S. economy grew, the amount of U.S. dollars in circulation increased. Many countries began to accumulate large reserves of dollars, but by the 1960s, the U.S. began to face a growing balance of payments deficit. The U.S. was spending more money abroad, particularly on military operations in Vietnam, than it was receiving in return. As a result, the U.S. started to run low on the gold reserves needed to back all the dollars in circulation. By the end of the 1960s, the U.S. was facing economic instability, including high inflation, a large trade deficit, and the strain of funding the Vietnam War. Countries around the world, especially those with large amounts of U.S. dollars, began to question the U.S.'s ability to convert dollars into gold. There was growing concern that the U.S. would not be able to maintain its gold reserves at the $35 per ounce rate. In response, on August 15, 1971, President Nixon announced a series of economic measures known as the Nixon shock. The most significant of these was the suspension of the U.S. dollar's convertibility into gold. This effectively ended the Bretton Woods system and marked the final end of the gold standard. With the dollar no longer convertible to gold, the U.S. dollar, like most currencies around the world, became a fiat currency. This means that the U.S. dollar and eventually the euro, yen, and other major currencies would no longer be backed by physical assets like gold. Instead, their value would be based on government trust and the stability of the issuing country's economy. This transition to fiat money allowed for more flexible monetary policy. So, what exactly is fiat money? Fiat currency is a type of currency that has no intrinsic value. It's not backed by a physical commodity like gold or silver. Instead, the value of fiat money is derived from the trust that people have in the government that issues it. In essence, fiat money is valuable because a government says it is, and because people are willing to accept it in exchange for goods and services. Fiat currencies are used in nearly every country today, including the US dollar, euro, Japanese yen, and countless others. These currencies are supported by the full faith and credit of the issuing government, and their value is influenced by factors such as supply and demand, inflation, interest rates, and overall economic stability. One of the key advantages of fiat money is that it allows for much greater flexibility in economic management. Central banks can manipulate the money supply, adjust interest rates, and engage in other monetary policies to stabilize the economy and respond to crises. This flexibility has made fiat currencies the standard in the modern world, though they are not without their risks. Since fiat money is not backed by physical assets, it is more susceptible to issues like inflation and currency devaluation. Fiat money allowed for more flexible monetary systems, but also introduced new challenges. While the US dollar remains the world's reserve currency, the transition to fiat money has reshaped economies globally, influencing everything from trade to inflation. As fiat currency became the global standard, financial transactions evolved alongside it. The need for faster, more convenient ways to exchange money led to the birth of credit cards. These small plastic cards revolutionized commerce, allowing consumers to make purchases on credit without carrying cash. Over time, electronic banking, digital transactions, and eventually online payments emerged, paving the way for the seamless, cashless financial systems we use today. The history of credit cards began in 1950 with the launch of the Diners Club card, the very first credit card. The card was created by Frank McNamara, who came up with the idea after an embarrassing experience where he forgot his wallet while dining at a restaurant. The Diners Club card allowed customers to dine at participating restaurants and pay for their meals later, essentially introducing the concept of credit, buying now and paying later. At first, it was a simple concept, accepted only at a limited number of restaurants. However, this idea quickly gained traction. By the 1960s, more and more businesses and consumers began to see the value of using credit cards as a means of payment. In 1966, two of the most influential credit card companies in the world today were born: MasterCard and Visa. These companies expanded credit card usage far beyond just dining and established networks that allowed credit cards to be accepted in countless locations across the globe. The introduction of MasterCard and Visa revolutionized the payments industry. Unlike the Diners Club card, which was restricted to specific merchants, both MasterCard and Visa offered cards that could be used at a wide variety of retailers, from grocery stores to department stores and even travel agencies. These companies also introduced the concept of revolving credit, allowing cardholders to carry a balance from month to month, paying interest on any outstanding debt. The rise of credit cards was not just about convenience, it also brought about significant economic changes. People could now purchase items they couldn't necessarily afford right away, leading to an increase in consumer spending and a new consumer-driven economy. The widespread adoption of credit cards made purchasing goods and services more accessible, marking the beginning of the shift from physical cash to digital payments. While credit cards set the stage for digital transactions, the real revolution came in the 1990s with the rise of the internet and the birth of online banking. In the early days of the internet, people were skeptical about doing business online. Concerns over security, fraud, and privacy made many wary of using the web for financial transactions. However, as internet technology evolved and became more secure, people began to embrace the idea of online banking. In the 1990s, major banks started offering online banking services, allowing customers to manage their accounts, pay bills, and transfer money from the comfort of their homes. This shift marked a significant departure from the traditional brick-and-mortar banks, where customers had to visit in person. Online banking made it easier for people to access their finances, view their balances, and perform transactions anytime, anywhere. But while online banking was a major step forward, it was the emergence of companies like PayPal that truly popularized online payments. Founded in 1998 by Peter Thiel, Max Levchin, and Luke Nosek, PayPal was initially designed to help people send money via email. The idea was simple: enable online merchants and consumers to send and receive payments securely and efficiently over the internet. By the early 2000s, PayPal had become the preferred payment method for online shopping, especially for those purchasing from eBay. With its user-friendly interface, secure transactions, and ability to link to credit and debit cards, PayPal made online shopping safer and more convenient for consumers worldwide. The success of PayPal helped establish digital payments as a permanent fixture in the modern economy. As PayPal grew, the concept of mobile payments also began to take shape. With the rise of smartphones and mobile apps, the next logical step was to enable people to make payments directly from their phones. In 2014, Apple Pay was launched. allowing iPhone users to make payments with a simple tap of their phone. Other companies, such as Google with Google Pay and Samsung with Samsung Pay, soon followed suit. Mobile payments offer a level of convenience never seen before. Instead of pulling out a physical credit card or cash, consumers can simply use their phones to complete transactions in stores, online, and even within apps. The convenience of mobile payments has led to rapid adoption, with millions of users worldwide now relying on their smartphones to manage their finances. The shift to digital money and mobile transactions has also paved the way for innovations like contactless payments, where consumers can tap their credit or debit card on a point-of-sale terminal without inserting it into the machine or swiping it. This technology is becoming increasingly common, particularly in large cities and high-tech environments. And it's further accelerating the move away from cash. As more consumers and businesses embrace digital currencies, the future of money may move even further away from traditional government-backed fiat currencies. The increasing integration of cryptocurrencies, along with the growth of digital payment platforms, could reshape how we exchange value on a global scale. In addition, digital wallets, which allow users to store credit cards, debit cards, and even cryptocurrencies in one convenient app, are becoming more prevalent. These digital wallets are changing the way people interact with money, offering more convenience, security, and the ability to manage multiple payment methods in one place. The future of digital transactions is also linked to emerging technologies like artificial intelligence, AI, and biometric authentication. AI-powered systems can enhance fraud detection and make transactions even more seamless, while biometric technologies such as facial recognition and fingerprint scanning are likely to become more common in payment systems, further enhancing security and convenience. The rise of credit cards and the shift to digital money has transformed the way we make transactions and manage our finances. From the first credit card in 1950 to mobile payments today, we've seen an evolution that's made transactions faster, safer, and more convenient. As we look to the future, the advent of cryptocurrencies and digital wallets promises to take digital transactions even further. The world of money is evolving, and we are on the cusp of another major revolution. The rise of digital transactions is poised to continue shaping the financial landscape. Cryptocurrencies, such as Bitcoin and Ethereum, have already begun to challenge traditional forms of money. These decentralized digital currencies are built on blockchain technology, offering secure, transparent, and borderless transactions. Cryptocurrencies have the potential to further disrupt traditional banking systems, allowing for instant peer-to-peer payments without the need for a middleman like a bank. The story of Bitcoin begins in 2008, when a mysterious figure known as Satoshi Nakamoto published a groundbreaking white paper titled Bitcoin, a peer-to-peer electronic cash system. Nakamoto's identity remains a mystery to this day, but the ideas presented in the white paper would go on to reshape the financial landscape forever. Bitcoin was introduced as a decentralized digital currency that could be exchanged over the internet without the need for traditional financial institutions such as banks. Nakamoto's vision was to create a currency that could be used by anyone, anywhere in the world, without relying on a central authority like a government or financial institution to oversee transactions. This was a radical departure from the traditional financial systems that have dominated for centuries. In 2009, the first ever Bitcoin transaction took place when Nakamoto mined the Genesis block, the first block on the Bitcoin blockchain. This transaction marked the beginning of a new era in the world of money. Unlike traditional currencies, Bitcoin wasn't issued by a central authority or backed by gold or other tangible assets. Instead, it relies on a blockchain, a decentralized, immutable ledger that records all Bitcoin transactions. Bitcoin's appeal lies in its decentralized nature and limited supply. There will only ever be 21 million Bitcoins in existence, which makes it immune to inflation and government manipulation. This feature is one of the key reasons Bitcoin is often referred to as digital gold. Its scarcity and growing adoption have led many to view it as a store of value and a potential hedge against inflation. Since that first transaction in 2009, Bitcoin has grown exponentially. It has sparked the creation of an entire ecosystem of cryptocurrencies, each with its own unique features and use cases. Bitcoin's rise has prompted a global conversation about the future of money and the role of decentralized finance. While cryptocurrencies have revolutionized finance, they come with their own set of challenges and risks. One of the biggest is volatility. The price of Bitcoin can swing wildly, sometimes rising or falling by thousands of dollars in a single day. This makes it difficult for cryptocurrencies to function as stable stores of value or units of account. Investors and traders often experience significant losses, while others see massive gains. The volatility of cryptocurrencies is primarily driven by speculation, regulatory uncertainty, and market sentiment. Another challenge is regulation. Governments and regulators around the world are still grappling with how to handle cryptocurrencies. Some countries, like China, have outright banned Bitcoin, while others, like the United States, have introduced regulations aimed at preventing money laundering and fraud. The regulatory environment for cryptocurrencies is constantly evolving, and the lack of clear global standards creates uncertainty for investors and businesses alike. Another significant concern with cryptocurrencies, particularly Bitcoin, is their high energy consumption. The process of mining Bitcoin requires vast amounts of computing power, which in turn uses large amounts of electricity. Some critics argue that Bitcoin's environmental impact is unsustainable, especially as the world seeks to reduce carbon emissions. Efforts are underway to make cryptocurrencies more energy efficient, but this remains a key challenge for the industry. As we reach the final chapter of our journey through the history of money, we turn our attention to the future. The way we use and think about money is evolving faster than ever, with new technologies and innovations shaping the next phase of global finance. One of the most significant trends shaping the future of money is the rise of digital currencies, particularly Central Bank Digital Currencies, CBDCs. A CBDC is a digital form of a country's official currency, issued and backed by its central bank. Unlike cryptocurrencies, CBDCs are state-backed and operate under the full control of the country's monetary authorities. Several countries are already exploring or piloting CBDCs, including China, which has developed the digital yuan. The digital yuan is already being tested in various cities and is expected to be widely used in the coming years. By creating a digital version of its currency, China aims to have greater control over its economy, enhance the efficiency of transactions, and reduce the use of cash. In addition to China, countries like Sweden and the European Union are also considering their own CBDCs. Sweden's e-krona and the European Central Bank's digital euro are being tested as ways to modernize the financial system and address the increasing use of digital payments. CBDCs offer several benefits, such as faster, cheaper, and more secure transactions. They could also improve financial inclusion, especially in developing countries where access to traditional banking is limited. However, the introduction of CBDCs raises concerns over privacy, surveillance, and the potential for government control over personal finances. Despite these concerns, the global trend toward digital currencies appears to be accelerating. Another major shift on the horizon is the move toward cashless societies, where physical currency like coins and paper bills may no longer be needed. Some countries are already leading the charge, toward this transformation. Sweden is often cited as the most cashless society in the world. Over the past decade, the country has seen a dramatic decline in cash transactions, with more people turning to digital payments via bank cards, mobile apps, and QR codes. Sweden is now aiming to become the world's first entirely cashless country. Most businesses in Sweden no longer accept cash, and even some remote areas have embraced digital payments. This shift is driven by the country's advanced infrastructure, high levels of internet connectivity, and a strong culture of technological adoption. China is another nation moving toward a cashless society, though its approach differs from Sweden's. In China, mobile payment platforms like Alipay and WeChat Pay have become ubiquitous. These apps allow users to make payments, transfer money, and even access credit with a simple scan of a QR code. In fact, mobile payments in China have become so widespread that cash transactions are rare, even in small markets and rural areas. While the idea of a cashless society might sound appealing, offering convenience, faster transactions, and reduced costs, there are also potential downsides. The digital divide could leave older individuals, low-income people, and those without access to technology at a disadvantage. In addition, the elimination of cash could raise concerns over privacy and surveillance, as all transactions would be trackable and potentially subject to government oversight. Despite these challenges, the trend toward cashless societies is clear, and more countries will likely follow Sweden and China's lead in the coming years. From bartering to blockchain, the story of money is a story of innovation, power, and the relentless drive to connect people through value. As we move deeper into the digital age, one thing is clear: money is no longer just paper and metal. It's data, code, and possibility. Will cryptocurrencies redefine our future, or simply add a new chapter to an ancient story? Only time will tell. Thanks for watching The Currency of Time. If you enjoyed this journey, like, subscribe, and stay tuned for more stories from the economy that built our world.